Other than SoFi, I don't really talk about the moves that I'm making in my portfolio because I don't make many moves in my portfolio. Over the last 12 months, I've only sold out of one position completely, and I'm sure a lot of you know what that position is. And before that time, I don't think I've sold out of anything completely since 2021. However, over the last week, I completely sold out of two more positions, and I plan on continuing this trend towards more consolidation. And in this video, I want to explain my thought process and the goals for this exercise in general. So I first started investing in 2017, and I didn't really have enough capital to make it significant until 2020, and I was mostly just trading, making stupid mistakes. But I was learning, and I was learning with relatively small dollar-sized losses. As my career continued to grow, I started having more disposable income to put into the market, and I think the strongest suit that I've had so far have been the underlying habits of consistently DCAing in. I'm not necessarily a great trader by any stretch of the imagination. I have horrible timing, and a lot of my followers and my friends know that I have this Jim Cramer ability to buy something and it goes down or sell something and it goes up. But around the time when I started to seriously consider long-term investing was just around the time when the pandemic hit in 2020. This was also the time when I started opening a content creation account just to share some of my moves, my thoughts in the market in general. It was also an exercise to keep me more in tune with what was going on in the market so as to make better financial decisions myself. I also really enjoyed doing it, so everything sort of lined up. But as a result of this, in 2020, we were approaching this place in the market that was mass euphoria, right? We had the stimulus checks, there was a lot of disposable money, money that was being printed, that was being put into the market. And as a result, I tried to find arbitrage in smaller market cap companies instead of just going into the magnificent 7 companies, which would have, in retrospect, served me way better. I left a ton of money on the table doing this in the form of opportunity cost. And since it was a time of euphoria, for a good chunk of time, I made significant gains. My most prominent trade on a volume adjusted basis would have been Tesla. It's also the reason why it's over half of my portfolio right now. It's a company that I began accumulating in late 2019, early 2020, and then it just absolutely skyrocketed and it ran away from me completely. I think it did like a 5x or a 6x in the matter of a year or so. I dollar cost averaged up, and in 2020 I had a rule where every paycheck that I got, a certain percentage of that went into Tesla stock. And so every 2 weeks I was buying a handful of shares here and there. As a result, when you put together the gains and also the constant DCA, Tesla became over 50% of my portfolio. And on some good days it was even higher than that. And Tesla's had a rough couple of years since then, but I'm still holding on to that position, thinking of the long term, because Tesla is essentially this cornerstone position in my growth portfolio, and a lot of other positions are around that. Now, I think for Tesla, anything under 200 is a good opportunity to dollar cost average. I added significantly to my position in the low $100 range at the end of 2022. When the stock hit $110, I was buying heavily, as that was the point where I was actually averaging down on my position. I think my average on Tesla is like $120 or something to that effect because of the DCA up. So I bought consistently throughout 2023 as well. And then there's SoFi, right? This company that I've been owning. I initially bought SoFi at IPOE. I paid $23 a share for it when I first bought it in, I think, February of 2021. Super small position. I've also tweeted about this. I've been averaging down. I bought more heavily in the $4 range. I consistently averaged between $5 and $6 to the point where any purchases on SoFi right now is me dollar cost averaging up, because my average on SoFi is about $7.50, something like that. But anyways, that trend of making a lot of gains in 2020, 2021 turned around in 2022 as we had this hangover period from all of the stimulus that was being pumped into the economy. And a lot of these names that had high growth started underperforming throughout those years. And what I did was I started averaging down on a lot of them. So Pinterest and Unity are 2 positions that I averaged down on. Some of them, I just let them go below 50% in terms of losses. And as a result of that, my portfolio has become massively polarized, where there's a heavy concentration in 3 or 4 names that make up maybe 85 to 90% of my portfolio, and the remaining stocks are just 1% positions because of this dynamic. But you also have to consider that all of the new money that I got in 2023 was deposited almost exclusively into Tesla or SoFi, Unity, or Pinterest. And so even though 2022 handed me a lot of losses, I found that through that concentration in a small number of stocks, that can make up for a lot of the losses that you have in smaller positions. This entire concept that if you distribute $1,000 evenly across 10 names, even if half of them go to zero, one of your winners can 10x and you'll still be very successful, right? And this happens all the time. Like Meta did a 5x from the lows in 2 to 3 years. Nvidia has done like an 8x in the past few years. And so they're not these obscure companies that you need to find out that have a $100 million market cap that can do a 10x. It's like companies right in front of you that are doing these massive multiples. And this has recently led me to this thought process of opportunity cost. Some of these names I hold are never really going to make it back to the levels I bought them for. Others might make it back, but they might take a year or 2 years. And there's a few companies that the narrative has changed significantly. Back in 2020 and 2021, they had a strong trajectory of growth. They were growing 30%, 40%. And as a result, many investors, myself included, were more than willing to pay a premium for that growth. And then when the lockdowns came, that growth was cut in half. And many investors thought that, okay, well, it's fine because when the recovery comes, the growth rates are going to come back. And now what we're finding is that when the recovery came, the growth rates did come back, but maybe now they're single digits or in the low teens, as opposed to 30, 40, 50% where they were before. And so really the prices for the growth rates didn't make sense because this black swan event happened and the growth rates were cut in half, and a lot of these businesses are going to take a significantly long time to recover. And so the idea is that my thought process goes more towards this opportunity cost of holding these positions until recovery. Yeah, I could sell and I could buy AI stocks or Nvidia, and the learning curve for me to ramp up on that would be significant. I could go into the Magnificent Seven, although you have to keep in mind that I have a full other portfolio that's focused on dividends, that's focused on stable positions where I have Apple, Microsoft, I have ETFs, and so I have exposure into that. Right now on my YouTube channel, I only talk about my growth portfolio because that's just the interesting stuff to talk about. But if we merged both of these portfolios over, like the dividend one and the growth one, Apple would end up being like my fourth largest position, something to that effect. And so really, I've been thinking about shuffling some positions around in my growth portfolio. The other thing I leaned on was my general unwillingness over this time period to average down on these positions, because number one, I felt more comfortable to buy companies that I personally was confident in, such as Sofi or Tesla, because I just knew way more about these companies. And number two, this became a vicious cycle where, because these stocks are such a small percentage of my portfolio, I didn't have the time or the mental capacity to stay updated on everything about them. And as a result of that, I was less confident in them because the overall mind share, how much I was thinking about them, was very concentrated with, 2 or 3 names. And so when I thought about, okay, I have an extra $3,000, where do I want to put that? The answer was always Sofi or Tesla because I knew more about them. And as a result of knowing more about them, I was consistently reading up on more about them. And so some of these stocks just got forgotten. And I think that's a key point and a lesson that I'm taking forward, is that I want to have a strong correlation between where I do my research, where I put my attention essentially, and where I put my dollars. If I'm sitting around obsessing over a company like Sofi, that company should be an outsized position in my portfolio. On the other hand, if I don't even look at the earnings reports of a lot of these other companies, I'm asking myself, why is this a 5% position for me when I'm not even looking into it? And this really led me to go back and audit every position that I had, read up on the latest earnings reports of these companies, and really the guidance that they're providing forward. And what I'll add is that by doing this exercise, it reinforced in my mind that many of these companies are not bad companies. They're profitable in many cases. They have little to no debt. They have positive growth rates. They're still recovering. It's just that the valuations that I initially bought them for are bad. And the reason why is because I bought them on 2020 levels of growth, not on the current levels of growth. Looking forward, these companies are not outstanding, and so the options that I'm left with are two things. Number one, I can either average down and buy them at the new valuation, or I can sell and buy stocks that I'm more confident in and companies that I think will have a stronger rate of growth throughout the time period that we're entering right now. The result is essentially going to be a mixture between both of these options. So the two positions that I completely sold out of, and they're not necessarily bad companies, I just see better opportunities elsewhere. First of all, I completely sold out of my Corsair position because I looked at the latest earnings report and this company is growing single digits. And I think this can improve over time, but it's going to take a long time for Corsair to be at the position where it was when I bought them. And it's just too costly to be such a large position in my portfolio. I think Corsair was, 3 or 4% in my portfolio. Full disclosure, I took about a 40% loss on Corsair at the time of my sale. I think it came up to $5,000, something like that. The second position I sold out of was Revolve. This was one of my larger positions in the past 4 years, to the point where I think in 2021, Revolve was like my second largest position at the time. I've consistently trimmed and taken profits along the way because Revolve was a company that I bought consistently in the $15 to the $17 range. In 2021, Revolve shot up to $80 a share. And so I took some profits along the way. I sold some, at $30, $50, so on and so forth. I sold 40% of my Revolve position in early 2023, and I made a video about this as to why I was selling. Revolve, I think at that time was $28 or $29 a share, and the remaining position that I held fell all the way below my cost basis, and for several months in 2023 stayed there. Until recently, last week, they reported earnings and the stock shot up over 20%. And I took that as my opportunity to sell the remainder of my stock in Revolve. So Revolve is one that if we take all of the sells together, I did very, very well in that company. My Revolve gains definitely offset the Corsair losses by a good margin. So I was pretty happy over the past week because these proceeds from Revolve and Corsair, I cycled them into Sofi at $8.37, which I posted about last week. And then I also bought heavily into Celsius at the $60 range. The majority of my Celsius position is in Leaps, and those have done very, very well as Celsius reported earnings. I'm also interested right now in opening a position on Running, ticker symbol ONON. I haven't done so already, but I'm still reading up on it. But Running has earnings coming up on March 12th, so I might initiate a starter position soon. And also the other thing that I'm looking at right now is the supporting data around Bitcoin surging, the supply shock that we're seeing there. My Bitcoin position, it's my third largest position. It's about 15% of my portfolio. This has more than doubled despite me dollar cost averaging all throughout 2023. I've made several videos about this, particularly in the summer. I made a video as to why I was only buying Bitcoin all summer long. I think Bitcoin has room to run further past the $69,000 all-time highs. One of my positions from this is Coinbase, which has tremendously benefited throughout 2022 with the Bitcoin surge. My average on Coinbase is around $230, so I'm still slightly negative on that position, but I wanted to buy some more as this is going to benefit from Bitcoin. The other move that I'm considering is to buy CleanSpark, which is a Bitcoin miner, as they essentially serve as derivatives on top of Bitcoin, and so you'll get a premium multiple on it if you're confident in the underlying asset going up. And look, if Bitcoin does well this cycle, which I expect it will, because we're going into the halving in a month and a half, and historically after the halving, Bitcoin has done tremendously well in this bull market. Companies like Coinbase, which I own, and CleanSpark, which I plan to add, are going to do very well. And don't forget that I have the underlying asset as well, Bitcoin, which is a huge percentage of my portfolio. So it's a big bet that I'm putting on Bitcoin in this bull market. And the other thing that I'm thinking of doing is cutting some smaller positions like Etsy and Roku, which have underperformed over the past couple years. I suspect they will continue to underperform over the next several years. Full disclosure, I'm probably going to be selling both of these at a slight loss as well. However, I did make some substantial gains in Etsy because I started buying Etsy in 2019, and also in Roku. I've bought both of them in the $40 range historically, so definitely still at a profit on that perspective. Obviously, what didn't help is averaging up on these positions. When Roku fell from 400 to 200, I bought, and I also bought Etsy at over $100 a share when it rose on its way to 200. That said and done, I'll probably be taking a small loss on these positions, but nothing crazy. Even recently, just the Celsius gains alone of my selling Corsair and Revolve and putting that into Celsius made up for the losses that I'm eventually going to take on Etsy and Roku. So it's more of an opportunity cost of missing out because I've been having to hold on to these positions for so long without necessarily averaging down very heavily. But since I was fairly early in buying these companies in 2019, it's not the end of the world. And the thing that I want to reiterate is that these are just moves in my growth portfolio, right? I have a different portfolio with ETFs and that I don't really talk about on YouTube too much. I still have Tesla as my largest position, and I've not been DCAing that much into Tesla given just the other opportunities in the market. And since much of my Corsair money went into Sofi, Sofi's become like 35% of my growth portfolio, about 15% of my overall equities when you also layer in the dividend portfolio on top of that. In addition to shares in Sofi, I also own January 2025 leaps and 2026 leaps, with strike prices ranging from $5, $10, and $15 respectively. So that's what's on my mind right now. I've sold out of Corsair and Revolve and put that money into Sofi and Celsius, and that's done very, very well. I plan on selling my Celsius leaps and buying more underlying shares to build a stronger position in Celsius. They obviously did tremendous from their earnings last week, so I'm really, really happy that I bought them before that time. I'm actively researching more about On Running because I'm interested in opening a long-term position in the company. I'm considering selling my Etsy and Roku to add more Coinbase and to also start a position in CleanSpark as a trade. This is an important caveat. Bitcoin is going to surge this cycle. We're going into a bull market for Bitcoin. The CleanSpark idea is simply a trade which I would be selling out of at some point over the next 2 years. As Bitcoin continues running in this bull cycle, as we cross the halving and the anticipation climbs higher, it just seems that Bitcoin's at a supply shock right now. So I definitely want to take as much advantage of that as possible. Anyways, I hope you enjoyed this video and the transparency. I think, again, going back to that concept of one winner making up for all of your losers, if and when SoFi does go to $15 to $20 a share, let's say, just that alone, having so much concentration in my overall portfolio will not only make up for all the companies that I've booked a loss on, but it's also going to make up for all the opportunity cost of having held those companies for the past 2 years. And you'll end up beating the market overall over that same amount of time just from one winner alone. And so that's essentially what I'm looking to find. Yeah, a lot of these companies have not done well over the past 2 years, and I've held them, I've given them a lot of chances to recoup. But as the market now shifts from a bearish market towards more of a bullish market, I want to be in a position where I can take advantage of those. So essentially those are the moves that I'm considering in my portfolio. Some of them I've already executed, some of them I'm probably going to do this week, and others I'm still going to think about for a little while longer before I pull the trigger. Thank you so much for watching. Let me know your thoughts in the comments below.